This is a show where we help break down all sorts of concepts related to passive investing so you can go into your first or next deal with confidence. So be sure that you are registered for all future masterclasses and possibly to see our open deals at passiveinvestingwithwhitney.com. We do have deals open currently right now in multifamily, self-storage, car washes, real estate debt. I mean, pretty much everything but hotels. So, but anyways, and I'm just kind of babbling on. Let's go ahead and bring on our amazing guest. Danny, are you ready?
I am ready. I finally got my technology worked out, so thank you for everyone's patience.
Oh, it always takes a couple of minutes to get everybody sorted out in the room. And I already mentioned this at the very beginning, but there were only 3 people on when I mentioned this. Now we've got a full house. If you guys have questions as we're recording today's show, make sure you go to your Q&A box and I'll be helping moderate those questions live. If we don't get to it in our live recording, we're going to stop the recording and we're going to kind of have an Ask Me Anything session with Danny, which is such a real treat for everybody that's joining with us live. But make sure you find that Q&A box. Yes, the chat box doesn't work. Sorry about that, guys. It's just sometimes we get such a huge crowd on these shows, the chat box gets a little unwieldy. But anyways, let's go ahead and get started. Danny,
Perfect.
Awesome. Thank you so much for joining us today. And for those of you who didn't catch it, Danny is one of our founders and managing partners here at passiveinvesting.com. Danny, I'm going to step out of the way and let you introduce yourself and your role here at passiveinvesting.com.
Perfect. I am Danny Randazzo. I live in Charleston, South Carolina, so predominantly well located for our holdings kind of in the Southeast U.S. My wife and our 2 children reside here. We've got a golden doodle dog named George. So you will probably find us at a playground or walking with our double wide stroller, navigating some of the cobblestone streets of Charleston while trying to hold the coffee. So the cup holders in these built-in strollers don't quite work for the Charleston sidewalks because coffee will start going everywhere. Outside of doing our family thing and just enjoying where we live with passiveinvesting.com, I'm really over our kind of finance side of the operations and asset management. So it's been a tremendous journey for us as we've grown the team. And so anything that has to do with dollars, money, a checking account, debt, a mix of equity in there as well. So really my predominant focus is overseeing from an underwriting of a deal. So looking at the numbers, looking at our projections, making sure that it's a sound, safe, and conservative investment, both from a return standpoint, but also from an equity standpoint and an economic fundamentals. So some of those economic fundamentals, job growth, population growth, average household income, if we're looking at a multifamily acquisition, or just general demographics as well, if we're looking at storage or car washes or hotels. And then once we own these properties, so our portfolio now is about 1.3 billion. We oversee our asset management side of things. So making sure, on a daily, weekly, monthly basis, we are doing the proper activities at all of our different assets and asset classes to make sure we're meeting, achieving, and ideally exceeding the business plan. So as we've grown, we have always had a great mindset of growing the team and spending a lot more money on having the proper resources in the right places and the functionality to oversee this great portfolio that we have. So that's a little bit about myself and kind of what we focus on within the company.
Oh, amazing. And thank you so much for sharing that. But I want to ask you a little bit more personal question.
Yeah.
Because that's what I get to do here on the Masterclass, is get a little bit more personal with our guests. How did you get started in real estate to begin with? And then how did you transition into passive investing?
So, real estate for me, I got to go back several years. It was in my previous career and life as a financial consultant. I did that for nearly a decade, helping multi-billion-dollar companies and corporations around the world improve their own financial performance. So a lot of Excel modeling, metrics, income, different sources of income, optimization, expense optimization, people, process, technology, implementations, all done with a focus on net operating income or cash flow, and making sure that these multi-billion-dollar corporations can run their business effectively, but also make money at the end of every year. And so I did that. While I was doing that, I traveled probably 150,000 miles per year in an airplane. Year over year, I probably stayed in a hotel 200 to 300 nights out of the year. Now, some of those were elective, fun travel getaways to use all of the points that I accrued after staying for 200 nights out of the year. But I very quickly saw that that lifestyle, exchanging your time for a paycheck, was not a way to provide what I wanted for my family. And that pushed me to take a nice chunk of equity that I had saved up, really about $100,000, and put it into our first commercial property that my wife and I bought. And we bought that all with our own money, no investors, kind of proved the concept. And so that light bulb moment really went off. We bought $1 million office building. We put down 20%, so 200K is what we had saved up, put that into that deal. And we were generating about $5,000 a month in cash flow from that. So it was a very high producing cash flow deal. It was a commercial office building, and it was a great investment, but it required a lot of oversight from an owner's perspective. It wasn't very, it was a lot more passive than a single family rental, but not quite as passive as a passive investor in an apartment deal. And the risk that we ran with that commercial office building, if one tenant moved out, our building was now like 30% vacant. And so it would take a massive hit if we had a vacancy for a few months, and that cash flow would quickly disappear. Instead of being cash flow positive, now we'd probably be break even. And if one more tenant moved out, then we'd be losing money every month. But the deal worked out. It was a great producer. I sold it a few years ago and did well on it. But that was the first deal that we did. And then we did a wide variety of investing in different asset classes. We bought short-term rentals. We bought 4 units. We bought tax foreclosures, foreclosures at the courthouse. We bought smaller multifamily deals. And with that experience, I was able to really learn the difference between I guess the combination really of ROI, return on investment, and ROT, return on time. So these smaller deals, while the returns sound higher, right? Maybe you have a friend who has an Airbnb that they make 30% cash flow return on it, but that might be their ROI, but their ROT, they might be getting messages on the weekend about how the guests got locked out because they closed the door behind them, or they need more towels or linens. And so their return on time is terrible. And ultimately, that's not why we're in the business of passively investing for cash flow producing assets. And that really led me to multifamily investing with the size and the scale that it provides. And getting that experience, buying our first large apartment, led us down this path of really large scale, high quality institutional assets are the most predictable in terms of income optimization, predictability, and expense and management. Give me 1 second, George.
Oh man, I understand. I understand that. We've got a four-footed furry guest that wants to participate in the show.
That's right. So with that, the institutional quality assets really became a focus as we grew and came to scale, and it really provides the best predictability. It's one of the more secure asset classes out there, and it's just a good place to put your capital. So whether it's a storage deal, a hotel deal, a car wash deal, or a multifamily deal, buying, kind of the best in these markets, having excellent professional management in there allows us to have the scalability as well as the economic management to make them efficient, cash flow producing, safe, secure, and predictable to the best of our ability, barring any extreme world event or health event. We're in a very good position, and we learned a ton through COVID with our asset classes, that going after, again, these institutional quality assets, our resident base are the professionals who can work from home. And so our portfolio fared extremely well throughout COVID, and it just kind of really ingrained in us that conservative business approach of, okay, let's buy the nicest apartment community in the best area, close to all the amenities. It's 15 minutes away from Whole Foods. It has the best schools. Everybody wants to live in this area, but there's not enough nice apartments available to meet the demand. We've got ourselves a great little opportunity here, and it's the same basic concepts of the game of Monopoly, right? If you can own some of the best real estate on the board or in the market, and there's more demand to rent than there is supply, we've got a very good probability that our investment is going to generate income, produce monthly cash flow, and appreciate in value over time.
Awesome. And I love the fact that you referenced Monopoly. We have the National Parks version. So instead of Park Place and Boardwalk, it's let's see, I think it's Yellowstone and Yosemite. And somehow my daughter always ends up with those two. And she has yet to figure out how to build the campground, which is the equivalent of the hotel on there. So
nice.
I'm still in the game right now.
Yeah. And that's always been my personal investing mindset, and it really comes into the values and the principles that guide us at passiveinvesting.com today. I tell investors all the time, if I can't explain an investment opportunity to you in under 60 seconds, I've done something wrong, or if you still don't understand it, it's probably not the right investment for you, because we're just trying to keep it so simple, safe, and conservative, that we should be able to explain it very quickly.
Well, that's a perfect segue into our topic of today, because we have a lot of investor conversations where they're questioning what's most appropriate for my portfolio, equity or debt. And we offer both here at passiveinvesting.com. So let's just kind of kick it off with what are the two investments and how do they differ?
The basic difference between the investment types is debt has a fixed rate of return. It's secured by some sort of asset. In our case, we do first position liens on real estate at low leverage amounts. And so think about, as an investor, let's say you go to your local Bank of America and you are going to get a home loan for 70% loan to value, and you're going to put down 30% to buy your property, and you're going to pay the bank 5% interest on that loan. Think about us as the bank. We're collecting a fixed interest payment every month. Now, our loans are a little bit different than the bank because we're giving loans to investors and rehabbers. And so we're able to charge a higher interest rate. And that's why we can provide debt fund investors a 6% preferred return. And investors get their return first before any money goes on to the GP side of things. And so it's a safe and conservative investment from that perspective, because if we're paying investors 6% and we're charging borrowers about 12%, then there's a lot of room to ensure that even if one loan wasn't performing, investors are still going to get paid first and foremost every single month. And that's a good piece to have as I think about, part two of your question of like the personal portfolio mix. I personally love our debt fund as an LP investor myself. I like to put in a fixed amount of money into the debt fund as my family's kind of personal liquidity need. And so, the rule of thumb kind of that floats around out on the internet or with some of the financial wizards of today's world, right? They say you should save about 6 months of your household expenses in your savings account in case anything should ever happen to you. You can survive for 6 months. I think that's fair and reasonable. I would say if you're 55 and older, you should probably have about 12 months, again, just to be safe. And putting that money into the debt fund is a great place for you to have a personal portfolio allocation, because the debt fund with short-term loans, you're able to get your money back whenever you need it. And so if you put in $100,000 today and in 3 months you have a health issue and you need to do an out-of-pocket surgery that's going to cost you 15 grand, well, you can go and request 15,000 back and do that. Or if you had a life event occur and you needed to liquidate all of your money, you can do that because we're recycling loans. And so having that kind of 6 months or 12 months of average household expense reserve is kind of my personal allocation for the debt fund money, because I can earn 6% preferred return. It's in a safe and secure place. It's secured by first position liens on properties at low leverage amounts. If a borrower failed to pay, we can take back the property, we can sell it very quickly, recoup all of our equity in that deal, as well as any fees and unpaid interest. And, the investor is, again, very secure, earning that 6%. So that's how I think about the debt opportunities that are out there. In general, a debt investment will yield you some sort of interest rate or rate of return. And in most cases, that should be a fixed amount per month. I'm not sure, did you have any other follow-ups, Whitney, as far as like other debt investment options, or should we move on to like the equity side?
Let's move on to the equity side, because I want to be able to kind of, compare contrast a little bit between the two. That way, you know, as somebody who's listening to this and they're just like, ooh, do I want to do one? Do I want to do other? Or is there a case for both of those to be in my portfolio? But let's first define the equity side.
Sure. So the equity side is you have to think about yourself as an owner or an investor in that deal. From a debt perspective, you are not an owner, you are not an investor, you are really a lender. You're the bank. Equity side, you're an owner, you're an investor, you're very involved. Excuse me, not very involved. You're involved as an owner in the deal. From an equity standpoint, you know, I think returns can vary. So, you know, theoretically, as an equity investor, you should look for some sort of monthly cash flow distribution, whether that's 4, 5, 6% per year, and some sort of upside when that property exits or sells in the future. And so the difference really between the two, equity is going to be a fixed rate of return, no upside. There really shouldn't be any downside. So that's why the returns are going to be typically lower on a debt investment versus an equity investment. An equity investment should yield you some sort of cash flow over the hold period, and then an additional upside appreciation equity kicker when the deal sells or the deal exits, because as the equity investor or owner of the property, you should participate in some of that upside that gets generated over the life of the deal.
So that's awesome, because I loved how you put that, because I always talk about the 4 tenets of conservative investing: capital preservation, cash flow, equity, but there's a 4th tenet in there, tax benefits. So can you walk us through how the 2 different investments differ based on tax benefits?
Yeah, tax benefits on the debt side, there are none. Very simple. So you are going to earn fixed interest. Interest shows up on your K1 in a very specific box as predominantly ordinary income. So because you are passively involved in that deal, you may be able to offset the interest income generated from a debt fund investment by other losses from other investing activities that you have in the course of the year. The equity side of things, because you participate as an owner in that asset, the biggest tax advantage to real estate is depreciation. And being able to study the physical materials of how a building is built, we can break down that study into useful life buckets. And so one bucket loses its value very quickly over 5 years, let's say. And another bucket of materials holds value for maybe 15 years. And another bucket of value, like a roof, typically has a useful life of, let's say, 25 years. The shingles are built really well. They shouldn't really get damaged too much. You don't need to replace the roof every 5 years. You probably replace it every 25 years. And so on an equity investment, we can accelerate that depreciation, get a cost segregation study, and generate some extra losses earlier on in our investment period to help offset any income or cash flow that is generated. And so depreciation is one of the most powerful advantages that real estate investing has over any other investment in the world. There's no other investment where you can create losses without actually spending dollars to offset income. So the depreciation advantage is really, really important when you're thinking about real estate investing versus stock market investing versus debt investing. And the the last kind of tax advantage to the equity side of things is when you go to sell the asset, you as the investor have the opportunity, it's 100% your decision. You can either 1031 exchange that and completely avoid taxation, or if you need the money or you want to do something different with it, you can take that money, put it in your pocket, and get a K1 at the end of that year that summarizes your gain from the sale, and you would just pay tax on that based on the hold period for the investment. And so it's a real estate investing with equity is a way that the ultra wealthy people, when you read the Forbes 500 list, it's how people protect their money, their net worth, how they have it grow, and absolutely minimize the taxes that they pay to the government. And it's mostly done through significant real estate holdings. And so it's a huge advantage when we're talking about equity investing in real estate.
And thank you so much for that detailed breakdown. Guys, we're actually next week's webinar, if you guys are listening to this live, we are going to break down all different parts of depreciation, regular depreciation, bonus depreciation, accelerated depreciation. We'll deep dive into the 1031 exchange and just really just help illustrate the fact on the power of building wealth through tax benefits of real estate. Like what does that really look like? We'll paint that picture. But I want to kind of circle back because I'm sure there's some people here and that are looking at their portfolio before the end of the year and they're going, man, I have some additional funds to deploy. How should they be thinking about, do I go into debt? Do I go into equity? Do I do some sort of blend of both? Like I know you gave us a little bit of hint on what debt investing could be used for, but could you just paint a little bit broader picture?
Yeah. Number one, I would say you need to figure out what is best for you and your family and work backwards from there. So, if you're someone who is in the later stages of life, you might be retired or looking to retire in the next few years. I'm just going to kind of bucket everyone into the 55 and older category. If you're in that category, you probably want a portfolio mix that is a little bit more focused on monthly cash flow as opposed to higher growth. And I think there's a fair spectrum to mix. And so let me just break it down a little bit further. If you are in the prime years of your career, let's just say you're under 50 and you're working a full-time job, or you have a full-time business that you run and you generate plenty of income to pay for your household expenses and living and travel, blah, blah, blah. You don't need as much cash flow on an annual basis from investing. It's great to have it. You definitely want some in your portfolio, but you could be a higher allocation of your portfolio focused on that growth category. So more equity investing, higher multiples when there's exit activity or sales, versus if you are in your 50 to 70s, maybe you're kind of in that middle range where you have a good mix of growth opportunities and cash flow producing opportunities. And then, when you're in your later years, 75 and up, growing your money is less important than producing annual cash flow. And so I would probably dial it back a little bit if you're in that range where, monthly cash flow is really important if you're completely retired and you are using your equity to live and pay your bills and buy groceries, then cash flow is definitely really important. And, growing your equity, if you're 75, is not as important as producing annual cash flow to live. So that's kind of how I would look at the allocations. Specifically, let's just talk about the average investor avatar, if you will. If you are looking at your portfolio today, and you don't have some sort of reserve nest egg, kind of that 6 months of household household expenses put away, then I would put a little bit of money towards a liquid investment, which would be like our debt fund. You have access to your money. It's not tied up in a deal for 5 years or longer. You can get it if you ever need it, but it's still working and growing and producing income for you. And so putting some money into that.
Oh no,
What's that?
Whitney, you still with us?
I am. Can you see me?
Awesome, you paused.
Oh, my internet probably paused momentarily. Can you hear me okay now?
We can hear you now. We can hear you now.
Good.
What is that, Verizon?
So putting some allocation into a liquid investment like the debt fund, you can earn your 6%. You have access to your money when you need it. Very important to have at least the 6 months of household expenses to that bucket. I would then kind of look at your personal situation. If you are fully supported by your business or W-2 income coming in and you're not really focused on needing a lot of cash flow, then I would allocate more money to growth buckets. So that could be diversifying an allocation in, the car wash opportunities, putting some into self-storage, putting some into multifamily deals, and having it mixed and diversified, but knowing that you're going to produce some cash flow along the way, very important. And then you have that equity upside as well. The other thing that I would say is if you have a particular personal scenario, and let's just say you worked really hard and saved $500,000 for your 4 children to go to college, and you're going to pay for tuition and room and board for 4 kids, and hopefully $500K is enough to pay for tuition and meals and all that stuff for 4 years for 4 kids. But you need that money, and you're going to need to liquidate that over the next 4 years. Well, investing that in a 5-year deal is not going to be very good. And so, what would be a great idea would be to either take all of the 500, invest it into a debt fund opportunity where it can earn 6%. You can pull money as you need it, or maybe you take 400 of that and you put it into the debt fund with liquidity, and you put 100 into another deal, and you kind of plan for that. But I think there's different unique scenarios that every person may have, which is why I go back to my main point of you need to figure out what's right for you and your personal situation, and then work backwards to figure out how to get there. And so, I was having a conversation with an investor the other day, and they were getting ready to retire and plan for how to cover household living expenses from their retirement savings. And so going through the exercise to allocate, okay, we've got some money earning 6%. We've got some money earning 9%. We've got some money doing different percentages. And over the next 1 to 2 years, they don't really need access to any cash flow. But having a little bit more growth strategy is important for them so they can grow their money. And then in 3 years into the future, they have more equity in terms of a nest egg of dollars that, 6 or 7% return on that money is plenty to support their living expenses. And so, that's their goal of over the next 1 to 2, 3 years, let's grow the equity a little bit. But then once we're in that position, we're going to shift to a more cash flow focused portfolio so we can pay our living expenses and not have to worry about the stresses of financial living and management.
Oh, that's amazing. So, Danny, I want to make sure we leave plenty of time for our after party because we have some questions coming in that I think are perfect for that. But before we do that, I have 2 additional questions for you.
Okay.
Number 1, what is the top takeaway, main idea that you want investors to get from today's conversation?
The number one takeaway that investors need to take away is figure out what is best for you and your family. And again, kind of work backwards to get there. So over the weekend, I was telling you about the investor. I have chicken scratches of ideas that came to me on a quarter sheet of the Wall Street Journal to figure out how to allocate money in several different buckets. And so I think if you're an investor and you haven't done the exercise, figure out what your household living expenses are, figure out where you have your buckets of money saved up, and just go through the exercise. It doesn't have to be this super intricate, detailed Excel spreadsheet, but even on a piece of paper, the takeaway is really a homework assignment for people. Go through, figure out where you have your equity saved or invested, figure out the returns that you're getting, figure out what your household living expenses are, and see where there might be gaps that you need to fill, or see if you have stagnant dollars sitting not doing anything that you can put to work either in a short-term liquid investment or put to work in a long-term illiquid investment that has some growth potential. And so, I think it's an important exercise that every person does. In my household, we tend to do it around this time. Usually it's more around like the December 15th mark, so we can plan for January 1st. I'm pretty rigid in that. So my home is going to do that exercise here in about a month. And I keep it really simple. It's one spreadsheet, it's a couple of columns, it's several rows. But it's just an important thing for you and a spouse or you and a family member to know what's going on, where things are at. And it'll ultimately be your guide to make that investment decision of, do I go in a short-term liquid opportunity like a debt solution, or do I go into a illiquid kind of 5-year hold investment with higher upside?
That's amazing. And I think that actually kind of covers my second question, which was, what's your best piece of investing advice? I mean, that right there is gold. You guys should rewind this last 2 or 3 minutes because that will set you up very nicely going into 2023. But just, that's just an exercise that all of us should be doing at the end of the year to really help, not only like boost our returns, but, enhance like the overall performance like of our portfolios. So Danny,
Yeah, and the other quick thing on that is always question your ROT, your return on time too. I have another one of our investors, a good friend of mine here locally in Charleston, had called me a couple of times over the course of 2022 and was like, when do you have your next deal coming up? Because I've got to sell 10 of these rentals that I've been managing for the last 10 years because I'm not taking another tenant phone call for my single family house portfolio. I just want to enjoy the time with my kids and coach their baseball team and get me a deal soon because I got to sell these things. So I'm not taking phone calls from people. So I would also evaluate your existing portfolio to really measure not only your ROI, but your return on time. Maybe there's a investment that's, you know, sucking up your time and you just despise doing anything with it, and you would be so much better off without having it. Maybe there's a way you can sell it, liquidate it, and put it into something that lets you sleep better at night. Even if your return might be slightly less, at the end of the day, we're all trying to have more time, and don't let seemingly higher ROI give you away if it sucks up your return on time.
Well said. Well said. And I 100% agree with that. I mean, we've had a few conversations here on the masterclass where, I mean, the investors have heard me several times that I've had to, in the past year, fire not only my property manager, but Home Depot. Like, I was done. I was done dealing with all those calls. All right, Dee, thank you so much for joining us today. Guys, you don't go anywhere. If you're joining us live, we're about to start our after party. But if you're listening to us on your favorite podcast channel of choice, be sure to check out our open deals. And also you can schedule time with me at passiveinvestingwithwhitney.com. Until next time, we'll see you soon.